what was your like kind of volume look like when you did that phase of the burying the single family houses? And like, what were you doing?
Yeah. How many deals at once?
Yeah, how many deals did you?
Like
total.
At one point, we were doing 10 at once. We were selling some flips, and we started off a lot slower.
Yeah.
Right. We started off doing 1 or 2 at a time, and then kind of worked up to that. But we built a portfolio. I want to say it was 20 properties. I think it was worth about $5 million.
Okay.
And then, to finish that whole story, that was all in Fort Worth. 2021, I sat down with my business partner, and we were like, okay, we did the math, and we're like, we got like $2.5 or $3 million of equity in this portfolio that that we built through the burst strategy. But this thing's only cash flowing like $50,000 a year profit. Yeah. We're like, man, the return on equity here is pretty low.
That's what we talked about in the ad earlier.
We didn't have that Brandon Turner
tool. You didn't have the Brandon Turner ROE.
But we were like, man, the return on equity is not great on this.
Yeah. And which is the case with most people today with properties they own because rates went up. I mean, prices went up so high.
Yeah, I think every so often you got to look at your return on equity because if you're not, you could be getting far less than you think you're getting, right? And you feel like, well, I did the burst strategy, like I built all this equity, so I'm just happy with whatever I can get. But you're like, you don't realize that we basically said, okay, if we sell this and we move all this over into short-term rentals, we started doing the numbers. We were like, whoa, we need to do this yesterday. We're like, we'll go from $50K to $600,000.
Yeah.
That's what we did. So we sold everything over the next year. We're like, man, it's going to be a complete pain to do this. But we got to sell it because they were all rented. All these things were rented. And we're like, we got to let these leases burn off and we got to sell all these properties.
I bet you the average person's getting a less than 2% return on equity right now. The average real estate investor who owns property more than 5 years is probably getting 2% at max. Yeah. So if you could shift that to 10%, you 5x your cash flow and your equity doesn't drop.
I'm not good at math, but we've got about $7 million in equity and we cash flow about $160,000 a year.
Yeah,
that's not good.
Where's my phone? Hold on. What is 160,000 divided by 7 million?
It's a little more than 2%.
2.28%.
Dude, you're dead on the money, man.
So 2.28% ROE right now.
Yeah.
And that's if that, and I'm not questioning your run the numbers. Most people though, when they think they're making 160K in cash flow, they're really making more like 80 when it comes to like factoring in the
that's pure cash.
That's pure cash flow, which is the term that I use. But most people, so even if somebody else listening to this goes, well, I'm making 160, you're probably making 80 if you factor in the roof and the maintenance and the repairs and the vacancy and all that. So from people, even if they think they're getting 3%, they might actually be getting 1%.
Yeah.
So if you could take that equity right now, I'm not saying you should, but you could take that and dump it into something that gets you, for example, like not the plug Open Door Capital, but like one of our recent funds, it's like there's like a 9% pref, like 9% cash flow on your money. You go from 2 to 9. Like that's a massive increase in cash flow.
But you do have to factor in the fact that those loans are all on fixed, good, for the most part, good interest rates.
That's true, but it doesn't really. I actually would argue it doesn't actually matter that much.
Really?
And here's why. I mean, people say sometimes like, this is gonna be controversial, but I have a 3% loan. I have a 2.5% loan. I would never sell that. I'm like, well, it doesn't matter if you're paying an 80% loan or a 1% mortgage or you're getting free. The only thing that matters is cash on cash return, equity, and cash flow. Like those numbers, or IRR if you really want to throw it in there, those numbers matter. So the interest rate is irrelevant. If you're getting 2.28% and you're paying a 2% interest rate, and you dump it in something that you have to pay a 9% interest rate, but you're getting a 10% return on your money, you still 5x'd your cash flow, your equity stayed the same. It just doesn't really matter. That's my argument.
And I want to piggyback on this. Yeah. I could argue that you're even possibly in better shape doing what he just said, because when rates go down, you refi.
You can refi,
and
now cash on cash goes way up.
Yes.
Yeah, so if you can get higher cash flow at a higher rate,
yes,
it's probably worth doing that.
Yeah.
Because it's all about for me, it's all about that cash on cash return number.
And Warren Buffett compounded his money at 21% a year over his lifetime, became the wealthiest person in the world. So that compound interest is the name of the game with this. So if you're compounding your money at 2.8% versus 10%, it's insane.
It's insane 20 years from now.
Yes, 20 years.
But there is so many other factors that go into that 2.8%. The fact that it's appreciating over the last 3
agreed.
years,
Appreciation is a factor in that. You're right.
The fact that the loan is being paid down. I mean, you could look at that and say that, because it probably has grown at 20% year over year.
Yeah, you are right.
Net worth-wise.
Appreciation plays into it. But then I would argue, is St. Louis going to appreciate as much as Austin, as much as Dallas, as much as probably not. So therefore, if you could shift from a because we don't care about what it's appreciated in the past. We care about what's gonna appreciate.
Yeah.
So assuming all things equal, like in that regard, like going forward, is it better to get 2.5% in St. Louis or 8% in Austin? Not that you can get 8% in Austin, but let's just say you could. It'd be better to get 8% in Austin because still from this point forward, it's going to accelerate more in those other markets.
But the only way,
but you don't know Austin, and you could end up losing because of that. So,
in my mind, though, the only way to hit that 10% cash on cash return would be to either invest in a syndication or a fund,
which is
or
risky.
do short term or midterm
which
rental
requires
play,
work.
which is risky as well. But I
and
want
takes a lot
to
of
hear. I
work.
want to hear.
Yeah, I want to know your story.
Yeah, you just tell me what you would do. Well, tell me what you did. And then
So what we did was we're like, wow, we could go from 50K to 600, and we're like, I think the inertia for investors is having to sell. It's a pain having to sell, get tenants out or in their leases and sell. And then there's just the process of like, how do you move money over from a bunch of single families without doing a portfolio sale, right? So we were like, okay, what we're going to do is we're going to group these into 2 or 3 houses, and the market was hot, so it was easy to sell. And what we had to do is kind of try to time it where we sell 3, and these are like selling for like $250 a piece. So we got like $750,000 of sales proceeds. We would do 1031 exchanges, so there's no tax implications to this. And then we would 1031 that into a vacation rental cabin. And the really amazing part about this is we time the vacation rental thing as well. So in your scenario, if you got your 2% in St. Louis versus your 8% in Austin or 10% in Austin, if you can reasonably predict that the property you're putting the money into in Austin is going to outperform or at least keep up with your 2.8% over in St. Louis, then you could come out way ahead. So what we did is we moved the money into the Pigeon Forge Gatlinburg market and short-term rentals, and that market went insane.
the perfect time.
It went insane.
Yeah.
I mean, we bought one deal for one 4-bedroom cabin we got for like $450, and within the next year it appraised for $750. We didn't do anything to it. It just appreciation. I mean, so that whole market just went bonkers because when I looked at that market, my first deal up there, which is another little tip or nugget for the audience. My first deal I bought as an expired listing. I started calling expired listings, and I was like, hey, would you guys be willing to sell this for what you had it listed for? Because I was running the numbers, and I'm like, the cash on cash is insane on this thing. I was like, why did this thing, it had been pending. I was like, why did this thing fall out of contract? They said there's a really bad foundation problem. I was like, I own stuff in Texas. Like everything's got foundation problems, And I was like, what kind of foundation problem? They gave me the report. I was like, I'll take it. So I offered the same price, and then
That's a great strategy.
I was a broker, and I was like, I wrote that in as well. So I got paid. I got paid a 3% commission on this property. So I got a check at closing for nearly $20,000 to buy this property for way under what I thought it was worth. I bought that property. The cash down on that deal was $115,000. The first year that thing cash flowed, I'm talking money, profit out the door, net of debt and everything, $120,000. So over 100%.
That stuff makes me
cash
so
on
mad.
cash return. Okay, and the beautiful part about this is I used a cost segregation study to accelerate my depreciation. I had that bonus depreciation and all that going. So I didn't pay taxes for years on my income. And that's where, to me, real estate just far outpaces everything else. Like, you can change your life with the wealth creation that comes through real estate from the tax advantages.
Yeah.
You know this very well with your whole portfolio. But, I mean, the tax
I pay
advantages are
nothing ever.
nuts in real estate.
That's wild. Hey, if I could throw in one more mathy, I want to go back a second to one more reason to return on equity, why this matters so much. Let's say, I'm going to get a little bit nerdy here, but math-wise, but see if this makes sense. You buy a property for $100,000. Over time, it appreciates to $200,000. Let's forget about closing costs and all that, but it goes to $200,000. You have $100,000 in equity you built up, and you're making a 2.5% return on your money. Should you change that out? Even if you got a low interest rate, whatever. The thing is, let's just say the appreciation is exactly the same in St. Louis versus Austin, 5% no matter what. Well, 5% appreciation on $200,000 is going to add whatever 5%, right? A little bit. You take that $100,000 though and put that as a 20% down payment on a property in Austin. What are you buying? You're not buying a $200,000 property. You're buying a $500,000 property.
Exactly.
That is appreciating at the same 5%. So even if the appreciation was exactly the same, by buying a more expensive property with that equity, now you're accelerating 5% per year on $500,000.
Yes.
Not on the $200,000. So you're going to actually be making more than double the amount of money every year in appreciation than you would on the little deal. So
And more than double and more than double the depreciation.
And more than double the depreciation, you're going to get a massive chunk
Yes.
from a tax savings. So it's even more reason why we should be looking at our equity and saying, I'm talking to myself as well. I got properties making 2% right now. Like I should be taking that and then dumping it into a more expensive property that ideally cash flows the same or better, because it's going to appreciate. Now, there's a risk question here, obviously. Like, the Smokies could have gone the opposite way.
Right, exactly.
Right? People could just stop. Airbnb just goes over and nobody cares anymore. And now you're in trouble. So there's a risk component we have to weigh.
There is. And the risk component's there in St. Louis with your original property as well.
Yeah, there's risk no matter what.
Yeah, there's risk no matter what. So it's kind of like doing your homework and figuring out, where do I think this market's going over the next 5-10 years? And then I think being willing to constantly assess your equity and figure out, is it time to move it?
Yeah.
Because it's a pain. Like if you went and tried to sell all these apartments that you guys own,
It'd be,
it's a complete pain. But if you realize you got a 2.5% return on equity and you're like, we could go from $1 billion to $3 billion. You're like,
I got a property here in Maui that I have $450,000 in equity. Yeah. And I make zero cash flow on it. Like, it breaks even every year. And the reason why is because it's a long story that I've told before, but basically when I bought it as a three unit property, the county came in and shut me down and made me turn it back to a single family house. So the cash flow I thought was gonna be like, or $9,000 a month in revenue is now like $4,000. So I'm, whatever. But I've been keeping it for a number of years. But finally, like Micah, actually, one of my team members at Open Door Capital was like, hey, can I just buy that from you? And I was like, that's a great idea.
Yeah.
Like
doesn't cash flow.
Doesn't cash flow. And all of a sudden, now I'm gonna have a property. I'm gonna have that 450. I immediately turned around and actually did a private note on a buddy of mine has a portfolio of rentals, and I don't do almost any private lending. But he's like, hey, I'll pay you 10% on that 450. I was like, yep, no problem. I'll do that right now. So I'm making on a secured loan 10%. Well, it's all going through this week. So by the time this episode airs, I'll be getting
you 10.5.
I know. And so now all of a sudden, but I turned a property with lots of equity and no cash flow into now significant cash flow. So a lot of people sitting listening to the show right now are sitting with equity. We could harp on this all day long.